Hey everyone, welcome back to Corporate Decoder, the place where we spill the tea on company filings and their juicy secrets. Today we're diving into MillerKnoll's 2025 Proxy Statement, a document packed with executive pay, board decisions, and a look at how they've finished their fiscal year. Get ready for some honest insights because we are decoding what this all means for the company and its shareholders. Before we dive in, if you love getting clear explanations of complex corporate reports, make sure you're subscribed. And if you want to join a community of savvy investors and analysts, our Discord channel is linked in the description below. MillerKnoll has just dropped its latest report, and it gives us a peek behind the curtain of their business operations and financial health. They're talking about a strong finish to fiscal year 2025, with sales growing year over year despite a bumpy economic landscape. They've been busy opening new flagship stores and design centers, focusing innovation on things like healthcare and sustainable products. It sounds like they are really trying to make their brands more accessible and appealing. The CEO's letter really paints a picture of a company actively reshaping its customer experience. They've updated showrooms in Chicago, London, and New York, blending contract and retail spaces. The Chicago Fulton Market location, for example, saw an 11% increase in booked appointments after its redesign. They're aiming to create more engaging spaces that showcase their full product range. This international expansion seems to be paying off with increased sales and order volume in Europe. It's a clear strategy to not just sell products, but to create a brand experience that resonates globally. Beyond showrooms, MillerKnoll is pushing into healthcare with products like the Gemma collection, designed specifically for clinical settings. They're also focusing on higher education markets with brands like Moro and even tapping into the esports scene with Herman Miller Gaming. This diversification seems like a smart move to tap into more stable and growing markets. The retail strategy is also a big focus. They opened 4 new stores in fiscal 2025 and plan to open 10 to 15 more in fiscal 2026. Their goal is to more than double their store footprint in North America over the next few years, which shows a strong commitment to physical retail presence, especially as they see opportunities as market conditions improve. Now let's talk about the people steering this ship. The board of directors is listed with names like Michael A. Volkamer, who has been chair since 2000, and Andy R. Owen, the president and CEO. There's also a note that Michael Volkamer is retiring at the 2025 annual meeting after a long tenure, which is a significant leadership change. The board has key committees like audit, compensation, and governance and corporate responsibility. These committees are vital for providing oversight on everything from financial reporting to executive pay. And when it comes to executive officers, we see the CEO Andy R. Owen, CFO Jeffrey M. Stutz, and several other key leaders in product, strategy, and regional operations. It gives us a snapshot of the core management team. The company is gearing up for its virtual annual shareholders meeting on October 13, 2025. The agenda includes electing directors, approving executive compensation, ratifying the selection of their auditor KPMG LLP, and approving a new long-term incentive plan. A big item on the agenda is the Say on Pay vote, where shareholders give their advisory opinion on executive compensation. Last year, this got about 96% approval, which is pretty strong. The company seems to be linking executive pay to performance, which is generally a good practice. They're also asking for approval of their 2025 long-term incentive plan, which is essentially an update to their existing plan from 2023. This plan allows them to grant equity awards like stock options and restricted stock units to employees and directors. It's a key tool for attracting and retaining talent by aligning their interests with the company's long-term success. Let's get into the numbers. In fiscal year 2025, MillerKnoll reported net sales increase of 1.1% on a reported basis and 1.6% organically. That's modest growth, but growth nonetheless in what they describe as a dynamic macroeconomic environment. However, here's where things get a bit more interesting. Their operating margin took a hit, declining by 320 basis points on a reported basis. This means for every dollar of sales, they kept a lot less as profit compared to the previous year. They attribute this mainly to tariff impacts and a less favorable mix of products and sales channels. Even on an adjusted basis, which tries to smooth out some of the unusual items, their earnings per share dropped from $2.95. This suggests that while they are growing sales, their profitability taking a step back. Cash flow from operations was $29.3 million, a slight decrease from the prior year. They ended the year with about $93.7 million in cash, which is a decent cushion, but the drop in operating cash flow combined with the margin compression is something to watch. Now, about that executive compensation. The summary compensation table shows some significant figures. For fiscal 2025, CEO Andy Owen reported total compensation of over $6.4 million. The other named executive officers or NEOs also brought in substantial amounts, averaging around $1.9 million each. The company also reports its CEO pay ratio. For 2025, the CEO's total compensation was about $6.4 million, while the median employee earned around $72,000. This gives a ratio of 88:1. This means the CEO earned 88 times what the average employee earned that year. This is on the lower side compared to some companies, which can be a good sign regarding pay equity. This table is crucial for understanding how pay actually connects to performance. It compares the CEO's compensation, the average compensation of other NEOs, and the company's financial results like total shareholder return, net income, and EBITDA. For 2025, the company's total shareholder return was 83.91, meaning a $100 investment would be worth 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 83.99. Meaning a 10-on-direct investment would be worth $83.91. This is down from previous years, and given the slight drop in earnings per share, it makes that CEO pay, even with its ratio, seem a bit disconnected from the immediate performance. Looking at what they consider most important for executive pay, EBITDA as adjusted, operating earnings as adjusted, revenue, and relative total shareholder return are key. The fact that their actual performance for these metrics sometimes falls short of target, like the 48.6% payout on the annual incentive plan for fiscal 2025, shows that their pay for performance system is indeed in place even if the targets weren't fully met. Regarding their equity plans, they have about 6.1 million shares available for future grants, which is a significant portion of their outstanding shares. This shows a continued reliance on stock-based compensation to incentivize their workforce. On the audit front, they're recommending KPMG LLP again for fiscal 2026. The fees for KPMG were about $5.6 million for audit services and $0.9 million for tax services in fiscal 2025. The company seems confident in KPMG's oversight. They're also proposing to amend and restate their long-term incentive plan. This plan governs how they award stock options and other equity to employees and directors. And a key point is that it prohibits repricing options. This is a good governance practice to prevent executives from benefiting unfairly if stock prices fall. The total number of shares that can be issued under the updated plan is over 21 million. Let's look at the overall picture here. MillerKnoll is clearly making a strategic effort to revitalize its brand and customer experience through store redesigns and new market entries like healthcare. The sales growth is positive, but the shrinking operating margins and slightly lower earnings per share in 2025 wasn't stellar across the board, especially with the decline in reported total. Falterboard, especially with the decline in reported total shareholder return, the company is investing heavily in its retail expansion and product innovation, which could pay off if market conditions improve and their new strategies gain traction. Keep an eye on those operating margins, and 5Q20's executives are compensated at high levels, as is typical for their industry, and the CEO pay ratio is relatively modest. However, the pay versus performance data suggests that while pay is tied to performance, the performance in 2025 wasn't stellar across the board, especially with the decline in reported total shareholder return. The company is investing heavily in its retail expansion and product innovation, which could pay off if market conditions. Alright, that's our deep dive into MillerKnoll's 2025 proxy statement. What's your take on their executive compensation and financial performance? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more decoded corporate insights, and don't forget to join our Discord community via the link in the description. Thanks for watching, and we'll see you in the next video.